Chair Yellen, thanks for joining us.
Thanks for having me.
So,
my pleasure.
Tyler Matson was just talking about the dinner that Chairman Powell had with the president. You met with the president a couple times, President Trump.
Yes.
And you met with President Obama a couple times. What are the pitfalls? Why is it such a sensitive thing for the Fed chair and the president to meet?
Because the Fed is independent, and it's important for the public and for market participants to understand that the actions that the Fed takes are purely in response to its congressional mandate of maximum employment and price stability. There is some history of presidents trying to influence the Fed, and reportedly Nixon influenced Arthur Burns. So it's important for the sake of the Fed's credibility and confidence in the institution.
Right. So why meet at all if you have those concerns?
Well, the president is, of course, concerned about the economy.
Right.
And it's very natural for the president to want to hear the Fed chair's views on the economy and to understand that thinking.
You talked about a history of criticism of presidents of the Fed. There's pretty recent history of that. You must see the comments that President Trump has made about the Fed and the Fed chairman. Do you think, oh, wow, I'm glad that's not me? Or what is your sense of whether or not, of the propriety of that, really?
Well, I think a president has a right to express views. But there was a long history. I think it began with President Clinton, went through the Bush and Obama administrations of absolutely no comments by the president on the Fed. And, of course, throughout, there were always communications between the Fed and the White House. I had regular meetings with Secretary Lew and Secretary Mnuchin. I know that Chair Powell also has those meetings. So there is ongoing communication with members of the president's economic team and occasionally the president about the economy. But it is important for the Fed to be viewed as independent, and I worry that the comments threaten public confidence.
Let's leave the politics behind and talk about the economics right now. In December, the market seemed like they were sending a very strong signal that the economy was going to turn down this year, and the economic data kept coming in strong. Have you been in a situation like that? How do you handle the kind of market signal versus the economic data signal? What's the right one to believe?
Well, the economic data signals are important, but to some extent they're backward-looking. And I think the markets tend to focus on what they see coming down the pike. And it's important for the Fed to be doing the same thing. So far, the economic data for the United States is solid and strong. We've got, as you know, about the lowest unemployment rate in 50 years, continued solid job performance, low inflation. And my own view is that well, we've long expected growth to slow in 2019 relative to last year, which probably will come in around 3% or more. And we're seeing signs that the economy is slowing. I still expect the most likely outcome is solid growth in 2019. But there are downside risks.
What risks do you see, and how do you assess them?
Well, we are seeing slowing global growth. The data from China have been reasonably weak, and the European data has also come in weaker than I think had been expected. So there are those risks. There are risks stemming from trade policy, from Brexit, and uncertainties around various political decision-making. We've also seen, of course, a tightening of financial conditions, and for a long time, as the Fed raised short-term rates, indices of overall financial conditions were moving in the other direction. That's now changed, and we are seeing a tightening of financial conditions. So there are some things pulling down growth and less support this year than last from fiscal policy. But consumer spending is still 2/3 of all spending in the U.S. economy, and with slightly higher wage gains and strong job market performance, low debt burdens, I think consumers are in good shape to carry forward growth in 2019.
There's always a two-sided risk to the Fed acting,
Yes.
right? If it doesn't act, you risk inflation. If it does act, you risk recession or economic weakness. How do you judge the other side, the concern about inflation, that the Fed doesn't act, that perhaps there'd be an inflation problem?
Well, I think that is something that the Fed should be aware of. We have a very low unemployment rate. Traditionally, we have seen linkages between the degree of labor and product market slack and inflation. And that's a lesson of history that I think it's important for the Fed not to forget. But on the other hand, the linkages aren't all that strong, and it looks like over the last decade or two, the strength of the linkages between labor market tightness and wage and price inflation has become a much more muted relationship. So, for example, we've seen wage growth move up some as the labor market is tightened, but not a lot. And wage growth is still running just around 3% or slightly over 3%. And, you know, with 1% or a little bit more productivity gain,
right,
you're not seeing pressures on firms' profit margins. Unit labor costs are rising a little bit under 2%. So we're not seeing strong inflationary pressures, if any, emerge. Inflation is still running under, slightly under 2%, close, but after a long period.
So ultimately, it sounds like you're saying that the Fed has the luxury here to be patient and worry more about the downside risk because the upside risk to inflation is not all that present.
Yeah, I would say now that they're in a range of neutral, that it's not necessary to act preemptively. And many people do feel that there may have been a more fundamental change in the relationship between inflation and the labor market. And so waiting to see how does inflation evolve, is there any evidence of upside inflation pressure? So I wouldn't rule out that that could happen. It's possible, especially if we get strong growth this year and the labor market continues to tighten. It's not out of the question that the Fed might need to raise rates again, but waiting to see. And of course, there are risks on the other side. And so this is a time when being data dependent and looking at the data and assessing what it means for the outlook seems sensible to me.
So would you say that it's possible the next move is a cut by the Fed?
Of course it's possible. If global growth really weakens and that spills over to the United States, or financial conditions tighten more and we do see a weakening in the U.S. economy, it's certainly possible that the next move is a cut. But both outcomes are possible.
Let me push you a little further on this, just as a last question on it. If you did this for a long time, so if you were filling out the SEP, the Fed's forecast again, what would you have penciled in for 2019 for Fed policy?
Well, I might have penciled in something similar to the median,
which is two rate hikes.
December was 2 rate hikes. But I would have had a very wide uncertainty band around it. And one of the things that my committee tried to do was to add uncertainty bands around these forecasts, because it's very important for
and the market
people
ignores
to realize, nobody is certain what will be appropriate. And I remember that what's going on now reminds me a lot of 2015, 2016. We were on a path, we thought, to begin raising rates in 2015. In the summer of 2015, the Chinese devalued the yuan. There was a tightening of financial conditions. The stock market declined. We had expected that by September of 2015, we would begin raising rates. They've been zero for 7 years. We waited until December. In December, the median forecast in the dot plot looked for 4 increases in 2016.
And you did none.
We did one.
Let me bring it forward now and talk about some of the other risks out there. How big a risk are some of these trade tensions that are out there? And how much concern do you have about China's weakness hurting the U.S.?
So I think the trade tensions, if they're not resolved, can be a significant negative for the outlook. We're already seeing some impact on business confidence, and I think we could see a negative impact on investment spending and possibly also on consumer spending. Some of the soft indicators, the sentiment indicators, have weakened some. So I would worry about that. And Chinese growth clearly looks to have slowed, both from their numbers and the reports you're hearing from American firms doing business there. The Chinese really want to control the growth of debt, and they don't want to stimulate spending using the tools that they have used in the past, opening up the credit taps as they did after the financial crisis. They'd like to stimulate consumer spending, but they do have policy tools, and I anticipate that they will use them to continue to spur growth, although growth in China is on, and has been for some time, on a slowing trend.
You put the reduction of the balance sheet on autopilot, essentially. I don't know if you would own up to that, but
I will confess.
Will you confess to that?
I will confess to having used that word.
That you used that word? You said it's as boring as watching paint dry, and Jay Powell used some of those terms, and he got in trouble for using them.
He did.
Do you think that was a mistake, and is it right now, do you think, for the Fed to sort of say, you know what, we're going to be a little more sensitive with the reduction of the balance sheet to what's going on in the economy?
Well, I intended for it to be reassuring. And for a long time, it seemed like it was reassuring. And the reason it should be reassuring is I wanted to make sure that market participants and the public didn't imagine that as we removed accommodation, we would be using actively two separate tools, and that every time there was a meeting, we would be making decisions both about the short rate and the pace of runoff. I could envision nothing more confusing.
Right.
So the idea of saying, look, we're going to use one tool actively, short rates.
Okay.
The balance sheet, we will run off very gradually and in a way that is completely predictable. We have specified in advance. There's nothing more to learn about this. That will go on. That's what autopilot meant, and I thought it should be reassuring, and I think for a long time it was. Well, what it didn't mean was that we wouldn't pay attention to possible impacts of the runoff on market conditions, and if there were some, well, and after all, we had bought all those assets with the idea of pushing down longer rates.
So you think it's right now for the Fed to make that change and be more sensitive with the balance sheet?
Well, I think they should make clear that they're watching carefully what the balance sheet runoff entails, and will be sensitive, and offsetting it could mean making changes at the short end, not necessarily immediately making balance sheet changes, but it's probably important to signal that people are not asleep and ignoring the impact of that on the economy.
Dr. Yellen, thank you so much for joining us.
Thank you for having me.
Fed Chair Janet Yellen here from 30 Rock. Back to you guys.
All right, Stephen, our thanks to you and, of course, to Janet Yellen. She's still expecting solid growth in 2019. That plus more. Let's break it all down with Michael Farr, who's founder and president at Farr Miller and Washington and a CNBC contributor, and Greg Ip, who's chief economics commentator for the Wall Street Journal. Welcome to you both. Greg, what jumped out to you here? Was it the balance sheet remarks or what?
Well, first of all, it's like she never left the job, Kelly. I mean, she gave a bravura performance that could have been basically spliced into the press conference in Jay Powell's place. And in many ways, I think it was actually perhaps a press conference Jay Powell should have given, because I'll focus in on one specific thing that she said that Jay Powell did not say. When Steve asked her, you know, what would your dot plot show? She said, I would probably have 2 rate increases this year with wide uncertainty bands around it. If you think about it, Kelly, the mystery of the last Fed meeting was why Powell, just a month after saying we're going to have 2 rate increases this year, basically said, we're done. I mean, that's really the way he said it. The way Yellen said it was, well, we still think we might have more to do, but look at all these uncertainties about trade policy, about like China, about tightening of financial conditions. There's a wide uncertainty band around it. That's kind of more the sort of gradual move away from a tightening bias that you expect from central banks, not this abrupt move from hawkish to dovish with nothing to explain it in between.
And Michael Farr, that might explain why the markets feel such whiplash. It goes to show the importance of rhetoric maybe in this position, and that Janet Yellen does have a deep knowledge of economics. We've talked about this in the past, and kind of has wonky ways of communicating this stuff. Powell wants to be more straightforward and plain spoken, but perhaps he'll change his tune.
Well, and I think that she was a lot more plain-spoken than we've seen her, certainly when she was Fed chair. She could tend to be a little Greenspan-esque at times and left us scratching our heads. She was very straightforward. I think she gave a great endorsement of what the Fed is doing, how the Fed is doing it, and how Jay Powell is conducting himself. I thought all of that was good. The comment that got me, I guess, was that the comments made about the Fed by the president could threaten the public confidence in the Fed. I thought that was a very important point, because that public confidence in the Fed really pulled us out of the big banking crisis in 2009. It was the stress tests, and it was the messaging from the Fed that reinserted the good faith and credit of the central bank back into the banking system and got us moving again. So it's really important that they do stay independent. What we've heard, though, from her was that things, at least from the Fed's actions and perspective, look like they're on the right track, could continue, and they're going to be sensitive about that balance sheet.
So, Greg, going back to the point you made, and I want to make sure that people caught this, if they missed it, you said that was the press conference that Powell should have given. Now, it is interesting that she's coming out and being, and doing this interview. Of course, she's on the speaking circuit. She works at Brookings. She's out and about. What do you make of that? I mean, people are going to draw the comparison that you just drew. Should she be giving Powell a little bit more leeway?
She wasn't critical of Powell at all. I'm being more critical of Powell right now than Yellen was.
Right, the way, but you're saying that the contrast is so great that it diminishes him.
No, I don't actually. If I left that impression, that's not what I meant to say. The nuance that I'm talking about is not one that broadly makes a big difference in the end. It's more important that Powell get the policy right than that he get the message right. The message will eventually follow. And look, Yellen had a little bit of trouble in her first year. Ben had some, Ben Bernanke before. Every Fed chairman is allowed a couple of sort of like missteps in their first year, and there's nothing fundamentally wrong with the policy that Powell is following right now. What he hasn't yet given is, I think, a good description of the overall framework that determines what he thinks the path for rates should be. I'm still unclear on exactly why he doesn't think that the Fed doesn't need to raise rates any longer. Is it because he's aiming for an inflation overshoot? He wants inflation to be higher than 2%? Is it because he thinks that the economy's underlying growth rate is actually somewhat fragile, the so-called secular stagnation story? Is it because there is, God forbid, a Powell put, and he's hypersensitive about the markets? These are questions I don't think have been adequately answered.
So, Michael, let me turn back to you. When the chair spoke there about quantitative tightening and putting it on autopilot, which she copped to as the originator of that phrase, she said she meant it as a reassuring sort of quotient in the equation, and that obviously under Mr. Powell, who was criticized for using the same word, it had ceased to be so.
You know, Tyler, that was the one thing that I heard Chair Yellen say that struck me as perhaps a bit disingenuous. I think that the Fed really wants to get rid of that particularly large portfolio. I think there's a slow rolling tightening as that portfolio is sold off and tapers off. So I think, yes, perhaps she wants it to be reassuring, but I really think what they want is they don't want the market to focus on that. They want that to sort of just blend into the background noise, and we're not really supposed to be all that aware of an ongoing Fed tightening. That she said she would be sensitive now in looking at that, were she still in that chair, it kind of, I think, gives Jay Powell a little bit more room. She was a very dovish Fed chairman. I'm not surprised that she would be a little more sensitive to perhaps backing off of that. But she gives Powell some room to do it.
All right, folks, thank you very much. Greg, great to see you. Michael,
thanks.
Thank you as always. Let's bring in Rick Santelli. Shall we bring in Rick Santelli now to get his reaction to the interview with Chair Yellen? Rick.
Well, thanks, Tyler. You know, a very good job by Steve Leisman and Janet Yellen. I think there's two things I walk away with. The first thing is I really can't jump into this inflation argument, especially when it always comes back to the two pillars. One pillar, of course, is maximum employment. The other is stable prices. And I'll tell you why it's disingenuous. Because when Janet Yellen's term began in February of 14, 10-year break-even rates, a good gauge for inflation, were around 220. When she left in Feb 18, they weren't much lower, around 200, 210. The point is, the whole range of her tenure was 120 to 220. And she did her first tightening in mid-December of 15. The break-evens were on the lower end of the range, around 150. Okay, so right there, if you're data dependent, that was the worst point to pick if you were really paying attention to the data. So it wasn't data dependent. And that flows very nicely with the fact that she wanted to have autopilot. And at the time, the markets didn't really have a huge hissy about that. But the issue is autopilot isn't reassuring to the markets. The markets are fickle. And I think a big difference between Janet Yellen and Jay Powell is that he understands markets and you need to pay attention and they can change their mind quickly. At the end of the day, it doesn't like anything carved in stone. And I think much of her tenure was carved in stone. Kelly, back to you.